There is a new banking rule taking effect in 2026 that every single person receiving Social Security or a pension needs to understand before it affects them. And right now, the vast majority of retirees, disabled Americans, and pension holders across this country have never even heard of it. This rule involves a $250 threshold that is quietly reshaping how banks handle incoming deposits, including the government benefit payments and pension checks that millions of Americans depend on every single month to pay their bills, buy their groceries, cover their medications, and keep their lives running. I want to be absolutely clear with you from the very beginning of this video. This is not a rumor. This is not political noise. This is not something that might happen someday. This is a real documented rule change that is already being implemented inside the American banking system right now, and its effects are going to be felt by millions of people who had no warning and no preparation. My name is William, and you are watching Benefits Update Central, the channel that exists specifically to make sure you are never blindsided by changes that affect your financial security. Today, we are going into full detail on this $250 bank rule. We are going to cover what it is, where it came from, exactly how it affects the way your Social Security and pension payments are received, what the risks are if you are not prepared, and most importantly, what specific steps you need to take right now to protect yourself. This is one of the most significant banking developments affecting retirees and benefit recipients in years. Stay with me through every section because every part of this matters. Before we get into the mechanics of this new rule, I want to paint an accurate picture of who we are actually talking about, because this context matters enormously when we discuss how a banking rule change affects real people. There are more than 70 million Americans currently receiving Social Security benefits in one form or another. That includes retired workers, disabled individuals, surviving spouses and dependents, and those receiving supplemental security income. On top of that, tens of millions of additional Americans receive pension payments. From government pensions, military retirement benefits, teacher retirement systems, union pensions, and private employer pension plans. For the overwhelming majority of these people, these payments are not supplemental income. They are not a bonus that makes life a little more comfortable. They are the entire financial foundation that everything else rests on. When that monthly deposit hits the account, it is already allocated. It is already spoken for. The rent is due. The car insurance is due. The electric bill is coming. The prescriptions need to be refilled. The groceries need to be bought. Every dollar of that payment has a job to do the moment it arrives. This is the reality that makes banking rule changes so consequential for this population. A change that might be a minor inconvenience for someone with significant savings and multiple income streams can be a genuine crisis for someone whose entire monthly budget depends on a single direct deposit arriving on time and in full and accessible immediately. According to data from multiple financial research organizations, more than half of Social Security recipients rely on their benefits for at least 50% of their income. For roughly 1 in 4 recipients, Social Security represents 90% or more of what they have coming in each month. Among pension recipients, the situation varies more widely, but many retirees, particularly those from public sector jobs, teaching, or the military, rely heavily or exclusively on their pension as their primary income source. These are not people with financial cushions. These are not people who can absorb unexpected disruptions without serious consequences. And that is precisely why understanding this new $250 bank rule before it affects you is not optional. It is essential. The $250 bank rule refers to a new threshold-based verification and processing protocol that financial institutions across the United States are implementing in 2026 for incoming electronic deposits. Under this rule, deposits that interact with accounts in ways that trigger certain automated flags, including deposits into accounts with low balances, accounts that have seen recent changes to their direct deposit information, or accounts where the incoming amount represents an unusual pattern relative to the account's history, are subject to an additional review process before the funds are released into the recipient's available balance. The $250 figure specifically refers to the minimum available balance threshold that many banks are now using as one of several trigger points for this enhanced review. If your account balance falls below $250 at the time your incoming deposit is being processed, your bank's system may route that deposit through additional verification steps before crediting the funds to your available balance. Let me explain why this matters so directly for Social Security and pension recipients. Think about the typical financial pattern of someone living on a fixed income. They receive their payment at the beginning or middle of the month. They use that payment to cover their bills and living expenses throughout the month. By the time the next payment is approaching, their account balance may be quite low, sometimes very close to zero. That is not a sign of financial mismanagement. That is simply the reality of living on a fixed income with a tight budget. Under this new $250 threshold rule, a recipient who checks their account balance a few days before their payment arrives and finds they have less than $250 in their account may experience a longer processing window for their incoming deposit. The bank's automated system flags the account because the low balance is one of the data points that triggers enhanced verification. The deposit may show as pending for several hours longer than usual. In some cases, a portion of the deposit may be immediately available while the remainder is held briefly during the verification process. Where did this rule come from? The origins trace back to a combination of regulatory pressure, industry-wide fraud prevention initiatives, and the broader modernization of electronic payment infrastructure that has been underway across the American banking system for several years. Federal banking regulators have increasingly pushed financial institutions to strengthen their fraud detection and prevention systems, particularly around the processing of government benefit payments. At the same time, private sector banking industry groups have developed new standards for how member institutions should handle high-volume recurring electronic transfers. And government benefit payments, including Social Security and pension disbursements, represent one of the largest categories of recurring transfers in the entire system. The $250 threshold was not pulled from thin air. It represents a data-driven determination by financial industry analysts that accounts falling below this balance level at the time of an incoming deposit show statistically elevated patterns of certain types of payment fraud. Whether or not that statistical pattern reflects any individual recipient's actual situation is irrelevant to the automated system. The flag triggers based on the data, and the additional review follows automatically. Under the new $250 rule, here is the sequence of events that may affect you. Your bank receives the electronic transfer from the Social Security Administration on your scheduled payment date. The bank's automated system immediately begins processing the incoming deposit. As part of that processing, the system checks several data points, including your current account balance. If your balance is below $250 at that moment, the system flags the incoming deposit for enhanced verification review. Once flagged, the deposit enters a secondary processing queue. In most cases, this queue moves quickly. We are talking about a matter of hours in the majority of situations. The automated system completes its additional checks, confirms that the deposit is legitimate, and releases the funds into your available balance. For many recipients, this entire process will conclude within the same business day, and the delay will be measured in hours rather than days. However, there are circumstances under which this process can take longer. If your account has recently had changes made to it, a new debit card issued, an address update, a change to your online banking credentials, the system may interpret those changes as additional risk factors and subject the incoming deposit to a more thorough review. If your account has been flagged for any reason in the past, even something as minor as a disputed transaction that was subsequently resolved, that history may still be present in the system and could contribute to a longer review window. There is also the question of partial availability. Some banks, under this new framework, are releasing a portion of an incoming deposit immediately while holding the remainder in review. For a Social Security recipient, this might mean that a set amount becomes available right away while the rest of the payment clears a few hours later. This partial release protocol is designed to ensure that recipients have access to some funds immediately, even while the full verification process is ongoing, but it can be confusing if you are not expecting it. You check your account, see that only part of your deposit has posted, and immediately assume something has gone wrong. Knowing in advance that this is a possibility removes that confusion. For SSI recipients specifically, this rule carries an additional layer of concern. SSI is designed for individuals with very limited income and resources. By definition, many SSI recipients operate with account balances that are consistently below the $250 threshold, not because of any problem with their account, but simply because their monthly benefit is modest and their expenses are real. These recipients may find that they encounter the enhanced verification process virtually every month, simply as a function of their financial circumstances. Understanding this pattern in advance is especially important for SSI recipients so that they can plan around the possibility of a same-day delay in accessing their full benefit amount. The impact of the $250 bank rule on pension recipients follows a similar pattern to its effect on Social Security deposits, but there are some additional nuances worth understanding. Pension payments come from a wide variety of sources. Government pensions, including federal civilian pensions, military retirement benefits, state and local government pensions, and teacher retirement systems, are administered by different agencies and dispersed through different systems. Private employer pensions are managed by plan administrators who work with financial institutions to process monthly payments. Union pensions operate through their own administrative structures. Each of these pension systems transmits payments electronically, and those electronic payments land at your bank subject to the same processing rules that apply to all incoming electronic deposits, including the new $250 threshold verification protocol. For pension recipients, one particular area of concern is the interaction between pension income and Social Security income. Many retirees receive both. They may receive their pension payment at the beginning of the month and their Social Security payment mid-month, or vice versa. Under the new rule, the timing and sequencing of these two income streams could affect how each one is processed. If your pension payment arrives when your account balance is strong, it may process smoothly, but by the time your Social Security payment arrives later in the month, after some of that pension income has already been spent on bills and expenses, your balance might have dipped below the $250 threshold, potentially triggering the enhanced review for that second deposit. Military retirees and veterans receiving pension benefits through the Department of Veterans Affairs should be particularly attentive to this update. VA benefit payments and military retirement payments are among the categories of government disbursements that fall within the scope of the new processing rules. These payments tend to be reliable and consistent, which is exactly why disruptions to their timing can be so disorienting for recipients who have come to depend on a precise monthly schedule. For those receiving private employer pensions, the situation may vary depending on which financial institution your pension administrator uses to process payments and which bank holds your personal account. The interaction between the sending institution's systems and your bank's new verification protocols will determine how quickly your payment clears. In some cases, this will be seamless. In others, there may be a brief delay. The key point for all pension recipients is the same as it is for Social Security recipients. The payment itself is not in jeopardy. The amount you are owed has not changed. Your eligibility has not changed. What may change is the brief window between when the payment is transmitted and when it appears in your fully available balance. Payment fraud targeting retirees and benefit recipients has reached genuinely alarming levels. Reports from the Federal Trade Commission, the Consumer Financial Protection Bureau, and multiple state attorneys' general offices have documented a dramatic surge in fraud schemes specifically designed to intercept, redirect, or steal government benefit payments and pension disbursements. The methods being used by fraudsters have become increasingly sophisticated. Account takeover attacks, where criminals gain unauthorized access to a recipient's online banking credentials and then redirect incoming deposits to accounts they control, have surged. Synthetic identity fraud, where criminals create fake identities using combinations of real and fabricated personal information and then establish accounts specifically to capture redirected payments, has become more prevalent. And social engineering schemes, where criminals manipulate recipients directly into changing their own direct deposit information to an account the criminal controls, have caused enormous financial harm to vulnerable Americans. The $250 threshold rule is one component of a broader fraud detection framework that uses multiple data points to identify transactions that show elevated risk characteristics. A low account balance at the time of an incoming deposit is not, by itself, evidence of fraud, but in combination with other signals, a recently changed direct deposit source, an account with limited transaction history, unusual geographic patterns in account access, it contributes to a risk profile that the automated system uses to decide whether to apply enhanced verification. The irony, of course, is that the very population most likely to have account balances below $250, fixed income retirees and benefit recipients, is also the population that the fraud prevention system is most actively trying to protect. A rule designed to shield vulnerable recipients from fraud may, in practice, create temporary friction for those same recipients as a side effect of the protection it is providing. This is not a comfortable tension, but it is a real one, and acknowledging it honestly is important. The financial industry is trying to solve a genuine and growing problem. The solution it has implemented has real costs for real people in the form of processing delays and temporary holds. The best any recipient can do is understand both sides of this equation, appreciate that the rule exists to protect them while also taking practical steps to minimize the ways it might disrupt their financial routine. Understanding the rule is essential, but knowing what to do about it is what actually protects you. Here is a comprehensive step-by-step action plan for every Social Security and pension recipient reading this right now. Step 1. Build and maintain a $250 minimum balance if at all possible. The single most direct way to reduce your exposure to the new threshold rule is to maintain at least $250 in your account at all times. I understand that for many recipients on tight fixed incomes, this is genuinely challenging. But even a modest effort to build toward this buffer can make a meaningful difference. If you can redirect even a small amount each month, $10, $20, $25 toward building this minimum balance, you will significantly reduce the likelihood that your incoming deposits trigger the enhanced verification process. If building a $250 buffer feels completely out of reach given your current circumstances, there are other steps on this list that can help compensate. But this first step, if achievable, provides the most direct protection against the specific threshold that triggers enhanced processing. Contact the Social Security Administration and your pension administrator and confirm that every piece of banking information they have on file for you is completely current and accurate. This means your bank's routing number, your account number, and the type of account your payment is directed to. Routing numbers can change when banks merge or are acquired. Account numbers change when you open a new account. If you have made any changes to your banking situation in the last year or two and have not updated your payment sources, do it now. Outdated banking information creates complications that go far beyond a brief processing delay. A payment sent to a closed account can take weeks to recover. Call your bank's customer service line or visit a branch and have a direct conversation about the new processing procedures for incoming government and pension deposits. Ask them specifically whether they have implemented the $250 threshold verification protocol. Ask what your account's current processing timeline looks like for incoming direct deposits. Ask whether there are any flags, holds, or restrictions currently on your account. Most bank representatives will be able to give you useful information. Some may not be familiar with the specific terminology of the new rule, but they should be able to tell you whether there have been any changes to how incoming deposits are processed and what their current timeline looks like for government benefit payments. While you are at the bank, ask about any programs they offer for seniors or fixed-income customers. Many banks have specific account types or service programs designed for customers on fixed incomes that may include features like waived minimum balance requirements, fee waivers, or priority processing for government benefit deposits. If such programs exist at your bank, this is the time to find out about them and enroll if you qualify. Activate every account monitoring and alert feature your bank offers. Text alerts for incoming deposits, email notifications when your balance drops below a certain level, mobile app notifications for pending transactions. Use all of them. These tools cost nothing, and they give you real-time visibility into what is happening with your account without requiring you to constantly log in and check manually. Setting a balance alert at $300, slightly above the $250 threshold, gives you advance warning when your balance is approaching the level that could trigger enhanced verification for your next incoming deposit. That warning gives you time to make adjustments if possible before your payment date arrives. Sit down with a calendar and map out your income and expense schedule for the next 3 months. Mark your expected Social Security payment dates and pension payment dates. Then mark every bill due date, automatic withdrawal, and scheduled payment. Look specifically for situations where automatic withdrawals are scheduled on the same day as an incoming deposit. If you have automatic payments set to pull from your account on the same day your Social Security or pension payment is expected to arrive, you are vulnerable to a timing mismatch under the new processing rules. If a deposit is delayed by even a few hours and an automatic withdrawal processes before the deposit clears, you could face an overdraft or a returned payment. Wherever possible, shift your automatic payment dates to 1 or 2 days after your expected deposit date to create a safe buffer. Federal banking regulations, specifically Regulation CC, govern how long banks can hold funds from incoming deposits before making them available. While these regulations provide banks with some flexibility for certain types of deposits under certain circumstances, they also establish clear limits on how long funds can be held and require banks to make at least a portion of deposited funds available within a defined time frame. Knowing your rights does not make a processing delay disappear, but it does mean you are not helpless. You have recourse, and understanding what that recourse is before you need it puts you in a much stronger position. Anytime a significant banking rule change makes news, scammers move quickly to exploit the confusion it creates. They build fraud schemes around real news stories because it gives their fake communications a surface-level credibility that makes potential victims more likely to engage. With the $250 bank rule receiving attention, you should expect to see fraudulent communications that reference it directly. You may receive a call, a text, or an email claiming that your payment has been held due to the new $250 verification rule, and that you need to call a number or provide your banking information to release the funds. You may receive a message posing as your bank warning you that your account is at risk under the new regulations, and that you need to verify your identity immediately. None of these are legitimate. The SSA will not contact you to demand verification before releasing your payment. Your bank will not send you an unsolicited message asking for your account credentials. If you receive any communication like this, do not respond. Do not call the number they provide. Do not click any link they send. Contact your bank or the SSA directly using official verified contact information that you find yourself on their official websites. New accounts present a particular challenge under the new verification framework. An account with limited transaction history gives the bank's automated system less data to work with when assessing whether an incoming deposit looks normal for that account. This can result in more thorough verification reviews for the first few payment cycles after a new account is opened, or after direct deposit information has been updated. If you have recently changed banks or opened a new account, give yourself at least 2 full payment cycles before you conclude that the processing timeline you experience in those first months is your new normal. The verification process typically becomes smoother as your account builds history and the system accumulates more data points to work with. If you have a representative payee. Some Social Security recipients, particularly those with certain disabilities or cognitive impairments, have a representative payee who manages their benefits on their behalf. If you have a representative payee, the new verification procedures may affect how and when your payee can access your funds. Make sure your representative payee is aware of this rule change and has taken the appropriate steps to understand how it may affect their access to your funds for the purposes of managing your expenses. I want to close by giving you a broader perspective on where all of this is heading, because this $250 rule is not the last change you will see. It is one chapter in an ongoing transformation of the American financial system that will continue to evolve in the years ahead. The direction of travel in banking technology is toward greater automation, faster processing, stronger fraud prevention, and more sophisticated risk assessment. The tools that banks use to evaluate incoming deposits are becoming more capable every year. Artificial intelligence and machine learning are being integrated into fraud detection systems in ways that allow banks to make more nuanced, data-driven decisions about how to process transactions, moving beyond simple threshold triggers toward more comprehensive risk profiles. For Social Security and pension recipients, this trajectory has both encouraging and challenging implications. On the encouraging side, as these systems mature and accumulate more data, they will become better at distinguishing between a legitimate fixed-income recipient whose balance is low before their monthly deposit and an actual fraud risk. The blunt instrument of a $250 balance threshold may eventually be replaced by more sophisticated analysis that is less likely to create friction for legitimate recipients. On the challenging side, the pace of change means that recipients need to remain engaged and informed about developments in the banking system on an ongoing basis. A rule that applies in one form today may be updated or replaced in the next year. New requirements may emerge that affect how you receive or access your benefits. Staying connected with reliable sources of information, like this channel, is part of how you protect yourself in an environment where the rules are always evolving. The Social Security Administration and pension systems are also continuing to modernize. The long-term vision for government benefit delivery involves more real-time payment capabilities, stronger digital identity verification for recipients, and tighter integration between government payment systems and banking infrastructure. These improvements are designed to make benefit delivery faster, safer, and more reliable, But the transition toward that future will inevitably involve some adjustment and adaptation along the way. What remains constant through all of this change is the fundamental mission of these programs: to provide financial security and stability to the Americans who have earned these benefits through decades of work, contribution, and service. That mission is not changing. The technology supporting it is changing. And recipients who understand that distinction, who can separate the stability of the benefit itself from the evolving mechanics of how it is delivered, will be far better positioned to navigate whatever comes next. A new $250 bank rule is taking effect in 2026 that adds an automated verification step to the processing of incoming electronic deposits, including Social Security and pension payments. This rule uses your account balance as one of several trigger points for enhanced review. If your balance falls below $250 when your payment arrives, your deposit may be subject to a longer processing window before the funds appear in your available balance. This rule does not change your benefit amount. It does not change your payment schedule. It does not affect your eligibility. It affects only the brief window between when your payment is transmitted by the government or your pension system and when it becomes fully available in your account. For most recipients, the impact will be a delay of a few hours within the same business day. For some, particularly those with consistently low account balances, this may become a recurring experience each month. For the minority of recipients whose accounts have additional flags or complicating factors, the delay could occasionally extend longer. Here is your action list one final time. Build toward a $250 minimum account balance. Verify all direct deposit information with the SSA and your pension administrator. Talk directly to your bank about their current processing timeline. Set up account alerts and monitoring tools. Map your payment dates against your bill due dates and adjust automatic withdrawals accordingly. Know your rights under Regulation CC, and stay alert to fraud schemes that exploit this news to target recipients. Your benefits are secure. Your money is coming. The system is adapting. And now, so are you. I am William, and this is Benefits Update Central. If this video gave you the clarity and preparation you needed to face this change with confidence, please hit the like button right now. It takes 1 second, and it tells us that this kind of thorough, honest, in-depth coverage is exactly what this community needs. Subscribe to this channel and ring the notification bell so you are always the first to know when something important changes that affects your benefits or your banking. And please share this video with a family member, a friend, or anyone you know who receives Social Security or a pension, because the information in this video could save them from a great deal of stress and confusion in the months ahead. I will see you in the next update. Stay informed, stay protected, and know that Benefits Update Central is always here to make sure you have the truth about what is happening with your money.